Okay, so in part 1 I spoke about the basics of investing in stocks, risk versus return, and dividends. And I briefly spoke about investing in funds. If you haven't watched it yet, you will find the video link here. I will also add it to the pinned comments below. In this video, let's dive deep into fund investing. I'm Vineet. Welcome back to my channel and let's begin. So, what are funds? Funds are essentially pools of money collected from different investors with similar investment goals. These funds are managed by professional fund managers who invest the money in various financial instruments like stocks, bonds, or others. The goal is to generate returns for the investors. How do these funds work? When you invest, you become a shareholder of the fund. The value of your investment in the fund increases or decreases based on the performance of the underlying elements of the fund. The fund manager charges a fee for managing the fund, which is deducted from the returns generated by the fund. How much is this fee? It depends on if the fund is actively or passively managed and other factors. Now, it is important to talk about the concept of active versus passive management before we go further. Actively managed funds are where the fund manager makes investment decisions based on their own research and analysis. The fund manager aims to outperform the market by selecting stocks or other securities that they believe will generate higher returns than the market average. Pros of actively managed funds are: number 1, potential for higher returns. Actively managed funds have the potential to generate higher returns than the market average if the fund manager makes the right investment decisions. Number 2, flexibility. The fund manager can adjust the fund's holdings according to the market conditions or their own analysis, which can help to reduce risk or take advantage of opportunities. Cons of actively managed funds are: number 1, higher fees. Actively managed funds have higher fees as compared to passively managed funds. This is because the fund manager charges fees for their expertise and the research and analysis they have performed. Number 2, risk of underperformance. There is a risk that the fund manager may not be able to beat the market and the fund may underperform as compared to the market average. So what is a good example of an actively managed fund? Fidelity Contra Fund, or FCNTX, is an actively managed mutual fund that invests in large cap US stocks. The fund manager William Danoff aims to invest in high quality growth companies that have the potential to generate higher returns than the market average. Okay, now let's look at passively managed funds. Passively managed funds are mutual funds or ETFs that track a specific market index such as the S&P 500 or the Dow Jones Industrial Average. The fund aims to replicate the performance of the index it tracks and does not rely on the fund manager's research and analysis. So what are the pros of passively managed funds? Number 1, lower fees. Passively managed funds have lower fees as compared to actively managed funds, mainly because they do not require the same level of research and analysis. Number 2, diversification. Passively managed funds provide investors with diversification across multiple securities, which help to reduce risk. Passively managed funds have some cons too. Number 1, no potential for outperformance. Passively managed funds do not have the potential to generate returns higher than the market average, as they simply track the performance of the index they follow. Number 2, no flexibility. Passively managed funds cannot adjust their holdings according to market conditions or the fund manager's analysis. So what would be a good example of a passively managed fund? Vanguard Total Stock Market Index Fund, or VTSAX. It is a passively managed mutual fund that invests in the US stock market. The fund tracks the performance of the US total market index, which includes large cap, mid cap, and small cap stocks. The fund aims to replicate the performance of the index it tracks and provides investors with diversified exposure to the US stock market. So basically, actively managed funds offer the potential for higher returns and flexibility, but come with higher fees and the risk of underperformance. Passively managed funds provide investors with lower fees and diversification, but do not have the potential for outperformance and lack flexibility. When choosing between actively managed and passively managed funds, you should consider their investment goals, risk tolerance, and preferences. And finally, the most important point to note is, over the long term, passively managed funds have shown to outperform actively managed funds on an average, and this is primarily due to their low fees. Okay, so now we know about the differences between actively managed and passively managed funds. Let's look at the different types of funds. There are several types of funds available in the market. Let's discuss a few of them. Number 1, equity funds. Equity funds invest in stocks of different companies. These funds can be further classified as large cap, mid cap, or small cap funds, depending on the market capitalization of the companies they invest in. Number 2, debt funds. Debt funds invest in fixed income securities like bonds, government securities, and others. These funds are suitable for investors who want regular income and are not comfortable with the volatility of the equity market. Number 3, balanced funds. Balanced funds invest in both equity and debt instruments. These funds offer a balance between risk and return. And finally, index funds. Index funds invest in a specific market index like the S&P 500 or the Nasdaq. These funds try to replicate the performance of the index they track. They are suitable for investors who want to invest in the stock market but do not have the time or expertise to pick individual stocks. Now we need to talk about why index funds are so important. Index funds have gained a lot of popularity in recent years. The main reason for this is their low fees and ease of investing. Index funds have a passive income strategy, meaning they do not try to beat the market but simply replicate the performance of the index they track. This makes them an excellent investment option for beginners who want to invest in the stock market but do not have the time or expertise to pick individual stocks. The low fees of index funds are also an advantage as compared to actively managed funds which charge higher fees for the expertise of the fund manager. Index funds have lower fees as they do not require the same level of expertise. This makes them an excellent investment option for long-term investors who want to minimize their expenses. Now, let's talk about how to invest in index funds. Investing in index funds is a simple process. You can invest in index funds through a broker or directly with the fund house. Here are the steps to invest in the index funds. Step 1. Choose a broker or a fund house. To invest in index funds, you need to choose a broker or a fund house that offers index funds. You can research different brokers or fund houses and choose the one that suits your investment goals and preferences. I personally use Freetrade and Trading212 here in the UK. Both of these offer commission-free trading. You can sign up to these using my referral link in the description and in the comments below. Step 2. Open an investment account. Once you have chosen a broker or a fund house, you need to open an investment account with them. This can be done online or in person. You will need to provide your personal and financial information to open the account. Step 3. Choose the index fund. Once you have opened an investment account, you need to choose the index fund you want to invest in. You can research different index funds and choose the one that suits your investment goals and preferences. And finally, invest. Once you have chosen the index fund, just invest. For me personally, a big portion of my stock market investments are in index funds. I have increased my investment in them more and more over the past year or so. This has immensely reduced the stress to find individual stocks to invest in and not worry about short-term fluctuations. Warren Buffett, arguably one of the greatest investors of all times, has said on multiple occasions that investing in index funds is one of the best strategies for long-term growth of wealth. And I couldn't agree more. It has been proven to be time and again one of the best and easiest investment strategies to follow and must do for beginners and everyone else. I hope you liked this video and found it helpful. Please subscribe for more helpful personal finance content and click on that like button to get this video recommended to other people. Also, please share your thoughts in the comments below. Thanks for watching and I will see you in the next one.